To understand the market thinking on the war requires an understanding that markets are cold-hearted. The fact that negotiations broke down over the weekend is important, but this is not the dominant input for the markets. Crude fell for the second straight day to test a low of about $90 a barrel, and not too long ago, crude was in fact threatening to break through about $120. Before the war, crude was in fact meandering in the gap of $60 to $70 a barrel. And analysts say that the International Energy Agency had pointed out that the supply hit is still not fully reflected in the prices. And still, the latest crude moves suggest an end to the war is near. The Wall Street stocks ended Tuesday with gains despite prevailing geopolitical risks. The Standard & Poor's 500 is trading close to its late January peak, and the tech-heavy Nasdaq 100 extended its winning streak to a 10th day, the longest since 2021. Asian stocks mirrored these gains, with the world's second best performer, Korea, leading the way. And the Indian benchmark soared over 1.6% to reflect global optimism and IMF's solid growth projection for the country. Now, in the middle of the war, the Standard & Poor's 500 is about to hit a new all-time high. When the war started, the Standard & Poor's 500 crashed 8.5%, wiping out about $5.3 trillion in market valuation. And now, from the 31st of March low, the benchmark is up almost 10%, adding $6.2 trillion back. And the strangest thing is, the war is not over yet. Negotiations have failed. The U.S. blockade of Iranian ports is active, and yet the Standard & Poor's 500 is just 1% away from a new all-time high. Wall Street moves suggest that bigger and the longer-term picture is more palatable from a cold market mindset. Even if Israel and Iran were to lob munitions at each other, markets will not care. And the markets will care if the U.S. is in the game and is ramping up risks. Now it seems that the U.S. prefers an off-ramp. However, things could, of course, change pretty dramatically in the coming days. While headlines offer little reason for optimism, markets seem to take a much more wait-and-watch sort of an approach rather than assuming what could happen. If anything, the glass is still half full when looking at the risk assets, but the strong performance of the risky assets stands in contrast to the still elevated oil prices and rates, which has raised questions about the consistency in market pricing. Higher energy costs and monetary policy tightening should, of course, be a drag on growth and negative for the stocks. For consumers, the prices of almost everything, including the pump, have surged. But markets seem willing to look through all of this.